Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, September 29th, and I'm recording this from our studio in Purchase, New York. As September draws to a close, the S&P 500 index has managed to defy the seasonal curse and has delivered a gain of almost 3%. As we approach the 3-year anniversary of the U.S. equity bull market this October, the index has now gained nearly 90%. Impressive as this is, it's hard not to see that this long equity boom has been a one-note narrative, the build-out of generative AI. Since the launch of ChatGPT in 2022, AI data center stocks have accounted for roughly 75% of S&P 500 returns, 80% of the earnings growth, and 90% of capital spending growth. Recently, however, we've seen several developments indicating that the boom may be entering its later phases. First, free cash flow growth at AI hyperscalers has turned negative as the arms race for computing power accelerates. Independent research firm Strategas estimates that free cash flow at the hyperscalers is on track to actually shrink by around 16% over the next 12 months based on 2026 forecasts. When the free cash flow growth of the most highly valued companies slows or turns negative, valuations come under question, and investors demand return on investment discipline. Further complicating matters, capital spending tends to involve multi-year projects and typically can't turn on a dime. Second, most of the hyperscaler cash flows that are funding the build-out in generative AI come from segments where growth is slowing. Businesses like search, digital advertising, cloud services, media, and streaming have been cash cows. But now price competition in these segments is heating up, adding to the pressure on free cash flow growth. Finally, and perhaps most concerning to us, is that deal-making has meaningfully increased in ways that smacks of speculation on unprofitable technologies and vendor financing strategies of old. For example, Oracle's massive commitment to build compute capacity on behalf of OpenAI will be financed with debt and has been pledged to a company with a fledgling revenue model. And NVIDIA, which depends heavily on just 6 hyperscaler customers today, has been moving to support Intel foundries and vendor financing for large language model developers like OpenAI. For now, the equity markets are pinning their hopes on a re-acceleration in economic growth. But despite all the current debates on the labor market, inflation, and the pace of Fed rate cuts, the durability of this 3-year-old bull market really rests squarely on its base, the AI capex boom story. And we're beginning to see the cracks. In market pricing terms, we believe we're closer to the 7th inning than the top of the first. We suggest selling small caps, unprofitable tech companies, and low-quality meme stocks while being highly selective in consumer-oriented names. Consider adding real assets like gold, REITs, energy infrastructure to a portfolio that is benchmark-weighted in passive U.S. equities. Also consider active stock selection in U.S. large-cap quality names. Specifically, we favor intermediate duration investment-grade fixed income, including municipals, international equities, including emerging markets. Rounding out our recommendations are hedge funds, private secondaries, and asset-backed lending and distressed investments in the private credit sphere. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.